Our next discussion involves corporate finance. Corporate finance is really just a discussion of how corporations can get money. Well, of course, it can earn money, but how can it get money to begin with? How can it get loans and get startup capital that is necessary to start doing the business for the company in the first place? Well, there are a few different methods by which companies can establish money, or make money, or make money in order to be used on behalf of the company. And we'll discuss their pros and cons and why they might not be such a good idea in some cases and why they might be good ideas in other cases. First one is operating funds. In other words, just use the money it has. Whatever money the corporation has, just go ahead and use it. Well, obviously, if you can do that, that's fantastic because you don't have to actually borrow any money and you don't have to go into debt. The problem is the company has to have sufficient profits to meet operating expenses and salaries in order to grow, and you can't use that money for dividends. In other words, if all you're going to do as a business is just simply use the money that you have, well, then it's very hard to grow. It's very hard to make new plants and buy make new investments, buy new things that can help you make more money in the long run. And also, the shareholders might get annoyed if you're making profits and not giving them the shares, not giving them the profits, because the shareholders want dividends. They want to get their share of the corporate profits. The second possibility of getting money, and here we're still talking about relatively small companies, is taking out loans from the bank. That can be a certainly an efficient way to get money to be able to get startup capital to do new investments and new procedures. The problem is, first of all, you have to have good credit to get a big loan. You may not have the kind of capital a bank, especially if you don't have the kind of history. It may not be that easy to get this kind of a loan. And second of all, too much debt on the corporate balance sheet is not a good idea. It can make investors, especially on the open market, more wary about buying shares of your company if your company has too much debt. Number three, you can issue shares of the company. In other words, you can sell equity in the company. You can sell components of the company. If you're publicly traded, it means floating shares on the open market. Even if you're a closed corporation, you can simply sell shares of the company to private individuals, either by advertising or by getting a broker or just by word of mouth. Of course, the pros of making money or raising money by distributing shares is that there's no debt. If a company sells $1 billion worth of shares in the open market, that's not a debt of the company. Of course, the downside is that it dilutes the value of the shares held by the current shareholders. If I own 50% of the company and then I sell 20% of the company, well, now I only own 30%. Again, seems pretty obvious. And if you're going to sell securities, especially if you do so on the open market, there are strict SEC regulations, Securities and Exchanges Commission regulations. Just going public, for example, just doing an IPO and putting your stock out on the open market, like the New York Stock Exchange, is probably going to cost tens of millions of dollars in legal fees and investment banking fees because it takes a tremendous amount of effort to put together all the documents that are necessary to actually be allowed to sell your shares in the open market. Another thing you can do is you can issue corporate bonds. Now, a bond is a loan that you're soliciting from an individual, and a bond, you're paying back interest. For example, you can say, I'll give you $1,000 bond, you give me $1,000, and I'll pay you 3% interest for the next 5 years, and then I'll pay you back the $1,000. Whatever. There are many different types of bonds. There are other courses that can cover exactly what bonds are and how they operate. I'm not going to get into that in too much detail right now, but it is important to mention just that corporate bonds are loans that you solicit from people out there in the market. They could be from private individuals, it could be mutual funds, it could be pretty much anybody that buys your bonds. Now, the advantage of that is, of course, you can raise a lot of money and you don't have to dilute your shares. You don't have to give people equity. You don't have to give people control of the company. However, again, you have SEC regulations when you're floating bonds, and just like taking out a loan from a bank, it adds to the company debt. If I sell a bond, well, then I owe that person money, and that adds to the corporate debt, which could make investors a little wary of it, and of course, it also means you got to pay it back sooner or later. These two types of distribution are called equity securities, or stocks, shares, or well, that's what an equity security is because you're getting equity in the firm, which means a percentage of ownership. And then there is a debt security. A debt security is another word for a bond. This establishes a debtor-creditor relationship in which the corporation borrows money from the investor to whom the debt security is issued. Again, a bond is really the best example of a debt security. Equity securities can be in the form of common stock, which means common stock means regular, plain old stock, a certain percentage of the company. If there are 1,000,000 shares outstanding and I own 1,000 shares, that means I own 1/1000th of the company. There are no preferences with regard to common stock. In other words, if there are dividends or if the company dissolves or whatever it is, I get treated in the same way as other common stockholders. If there's not enough money to pay everybody, well, then everybody gets paid proportionally based on what the company has. Corporations may issue different classes of common stock. There could be preferred stock. There could be stock, for example, that gets dividends first. There could be stock that gets dissolution money first. And of course, common shareholders have limited liability. If I own a share of Google, that doesn't mean that somebody can sue me personally if there was a problem with something that Google did. Then there's preferred stock. Preferred stock, as we discussed before, is a type of equity security that is given certain preferences. They can be based on classes, classes of shares that are being distributed, different series of shares. Series A has these rules and Series B have these rules, and preferred shareholders, just like all other shareholders, also have limited liability. Here are some examples of things that can define stock. It can be a right to get a dividend, defined preferred stock, excuse me, right to get dividends ahead of other types of shares, right if the company liquidates, in other words, goes out of business, a right to get the money before other classes, maybe a cumulative dividend right, in other words, the right to get a certain percentage, a certain amount of dividends before anybody else gets dividends, the right to convert to different types of shares, if you have maybe the right to convert maybe and buy more shares for a certain price, and the right to participate in the profits. These are just some examples of some of the things that can characterize preferred stock as opposed to common stock. There are different types of debt securities. Debt securities meaning loans that the company takes from the investor. You have the debenture and the bond, which essentially mean the same thing. It's just a question of whether it's secured or not. A debenture is unsecured, which means there's no collateral. There's nothing that can be collected, uh, can be held. If the stock isn't if the bond isn't paid. A bond is a long-term debt security that's secured by some form of collateral. But they both mean when the investor gives the company a certain amount of money, and that entitles the investor to a certain amount of interest. A note is a debt security with maturity of 5 years or less. Again, that's just terminology. And the indenture agreement has the terms of the debt. But these are all examples of loans that companies can take out from investors.